So you're curious about yield farming, huh? I get it. The crypto world, it loves to throw these buzzwords around, like passive income, sky-high returns, and it's easy to get caught up in all the hype. Especially a while back, seemed like everyone and their grandma was talking about it. Remember that craze a couple years ago?
Hard to forget. But yeah, let's not forget what came after. I mean, the Terry SD crash of 22, that definitely sent chills down a lot of spines. And not the good kind.
Yeah, for sure. That was a wake-up call for, I think, a lot of people.
Yeah.
But even with the hype cooling off a bit, yield farming, it's still a major player in this whole DeFi space.
Yeah.
You want to really understand it, right?
Yeah.
Beyond just the headlines and the hype.
Absolutely.
Which is exactly where this deep dive comes in. We're going to break down all the jargon, really explore how it actually works, and unpack all the risks involved. Because, let's be real, there's always a catch, right?
Especially in the crypto world.
Exactly. So to really ground our deep dive, we're starting with Investopedia's definition of yield farming. They describe it as basically putting your crypto to work on a DeFi platform to earn more crypto.
Okay. Sounds pretty straightforward so far. Almost like putting your money in one of those high-yield savings accounts.
Right.
Yeah.
Well, not quite. Here's where it gets interesting. We're not talking about your grandma's savings account at the local bank here. Yield farming, this all happens in the world of decentralized finance, DeFi, for those in the know. Meaning no banks, no central authorities, just code, smart contracts running the show. So instead of a friendly teller, we've got, like, lines of code calling the shots.
Pretty much. And I think that's both the beauty and the beast of DeFi. It's what makes yield farming potentially very lucrative, but also way riskier than your average savings account.
Okay, so maybe not something to park your rainy day fund in then.
Right.
But before we get to all the risky business, let's try to make this whole DeFi thing a little more concrete. Imagine, like, lending your friends some money, right, for their brilliant, hopefully, business idea. Except instead of just a handshake agreement, the terms, they're hard-coded into a smart contract.
And there's no guarantee your friend won't take that money and run off to, a tropical island, no hard feelings.
Right, good luck collecting on that loan agreement. But jokes aside, I mean, that's the gist of how DeFi works, right? It's all about these self-executing contracts that operate on these trustless systems. And as Investopedia highlights, I mean, people are putting serious money where their code is. Almost $8 billion flowed into yield farming in 2023 alone. This isn't just some niche experiment anymore.
Not at all. And that's why it's so important to understand what you're getting into. Because whether you're just dipping your toes in or diving head first, this pool is definitely open for business.
Okay, so we've established that yield farming is not your typical savings account, that's for sure. And that people are seriously invested, literally. But how does it actually work in practice? Investopedia, they break it down into 4 main roles that you can play: liquidity provider, lender, borrower, and staker. Let's unpack these, starting with liquidity provider. It sounds like something out of a superhero movie. What am I, like Aquaman, but with crypto?
Not quite, though you are providing something essential to this whole crypto ecosystem. Liquidity. You see, the crypto market, compared to, say, like the New York Stock Exchange, it's still relatively small.
So my crypto dollars, they actually make a splash, so to speak.
Exactly. Your trades, they have more impact. This is where liquidity providers, like our listener here, come in. They're like the oil in a well-oiled machine, making sure those trades happen smoothly.
And I'm guessing they're not doing it out of the goodness of their crypto hearts, right?
Of course not. There are rewards. But we'll dive into those and the other roles after a quick break. Stay with us.
All right, so before the break, we were diving into the deep end of DeFi liquidity pools. Not as glamorous as a dip in the ocean, but potentially a lot more rewarding. So how does one become a liquidity provider and rake in those crypto rewards?
Well, picture this. You walk into a crypto party. Think neon lights, digital avatars, the works. And instead of a bowl of chips, there's this massive pool filled with different cryptocurrencies. This, my friend, is a liquidity pool.
Sounds like my kind of party. So I dive in and start swimming in Bitcoin and Ethereum.
Hold your horses. You're not there to, like, hoard the crypto. You're there to keep the party going. As a liquidity provider, you deposit your crypto into this pool, and it becomes available for others to trade against. And the more crypto in the pool, the smoother the trading experience is for everyone.
So I'm like the generous host who keeps the drinks flowing.
Precisely. And just like a good host deserves a little something for their efforts, liquidity providers earn a share of the fees generated from every trade made using that pool. It's like passive income, but for your crypto.
Now that's what I call a win-win. But we've got a few more roles to cover here. What about lending and borrowing? That sounds a bit more like, the traditional finance world I'm trying to escape.
True, but with a DeFi twist. Investopedia mentions platforms like Compound and Ive. Think of them as your decentralized banks. Want to earn interest on your crypto? Lend it out. Need some crypto for a project? Borrow it, using your existing crypto as collateral.
Okay, but we're still in the Wild West of crypto, right?
Yeah.
What's stopping someone from, taking out a huge loan and then pulling a disappearing act?
That's where smart contracts come in again, remember? Everything is automated and transparent. But the value of your collateral, that can fluctuate, sometimes dramatically.
There's that volatility we hear so much about.
Exactly. If the value of your collateral drops below a certain point, you risk getting liquidated, meaning the platform automatically sells off your crypto to cover the loan. Not exactly a fun surprise.
Definitely not. So with lending and borrowing, it's all about uh, carefully managing your risk. No sudden movements.
Got it. What about that other term we hear thrown around a lot? Staking. It sounds so passive.
In a way, it is. Staking is particularly fascinating because it ties into, the fundamental technology behind certain cryptocurrencies. Remember our chat about proof of work versus proof of stake?
Vaguely. It was around the time I was picturing myself swimming in that crypto pool.
Right. Well, Investopedia does a good job differentiating the two. Proof of work, what Bitcoin uses, relies on miners solving complex puzzles to add new blocks to the blockchain. Think of it like a giant energy-intensive Sudoku competition.
And proof of stake is different. Significantly. Instead of miners, you have validators. These validators lock up or stake their cryptocurrency to participate in validating transactions and adding new blocks to the blockchain.
So instead of flexing their computational muscles, they're flexing their crypto holdings.
Exactly. It's like a security deposit that proves you have skin in the game. And the more you stake, the better your chances of being selected to validate transactions and earn rewards.
So it's kind of like earning interest just for holding your crypto.
In a nutshell, yes. And because it's less energy intensive than proof of work, it's often touted as a more environmentally friendly way to secure a blockchain.
Got it. So we got liquidity providing, lending, borrowing, and now staking. 4 very different ways to put your crypto to work. But before I start picking out my favorite DeFi strategy, let's talk about the elephant in the room, the risks. We've touched on volatility and the importance of smart contracts. But what other pitfalls should I be aware of?
Well, for starters, remember that crypto is still a relatively new and unregulated space. And where there's a gold rush, there are always going to be opportunistic individuals, we'll say, looking to take advantage.
Oh, no, you're not about to tell me about rug pulls, are you? It sounds messy.
Unfortunately, there are real risks in the DeFi world.
Okay, for those of us who haven't been to enough crypto parties, what exactly is a rug pull?
Imagine this. You're at that crypto party, the liquidity pool's overflowing, everyone's having a grand time, and then suddenly, the developers of the platform, the ones who set up the whole thing, they vanish. They pull the rug out from under everyone, taking all the crypto in the pool with them.
Ouch. That sounds like a nightmare scenario.
It can be. And it highlights the importance of doing your due diligence. Don't just jump into any pool that promises high returns. Look for established platforms, with a good track record, a transparent team.
So research is key. Got it. But it's not just shady developers we have to worry about, right? What about the regulators?
Ah, yes, the regulators. They're definitely starting to pay attention to the DeFi space, and things are getting interesting, to say the least.
Interesting in a good way.
Well, that depends on your perspective. Remember Kraken? They had to shut down their staking services in the U.S. because of regulatory pressure. And Investopedia mentioned that even Coinbase, one of the biggest names in crypto, they're facing scrutiny for their staking services.
So even if you're playing by the rules can change.
Exactly. The regulatory landscape is still very much under construction, which adds another layer of complexity and risk to yield farming.
This is starting to feel like navigating a minefield.
In a way, it is, but don't let that discourage you entirely. While the risks are real, so are the potential rewards.
That's what I like to hear. So before we wrap up, any last words of wisdom for our listeners who are now both excited and terrified by the prospect of yield farming? So we've talked about the excitement, the potential rewards, and let's be honest, the nail-biting risks that come with yield farming. But knowing all this, why do people do it? Is it just the allure of, striking digital goals or something?
It's definitely a factor, but remember that crash we mentioned earlier? The whole Terra USD situation wiped out what, billions of dollars practically overnight.
Yeah, not exactly a glowing endorsement.
Right. It's a stark reminder that yield farming, it's like a roller coaster. It's got those, stomach-churning drops. You have to be comfortable with that level of risk. And frankly, the possibility of losing everything.
Definitely not for the faint of heart. So if not just chasing returns, what else is drawing people in?
Well, think about it. Yield farming, at its core, it's about participating in a financial system that operates completely outside of traditional institutions. It's about individuals like yourself having more control, right, over their assets, how they're used.
I can see the appeal in that. It's like that Wild West spirit, but with code instead of cowboys.
Exactly. And while the Wild West definitely had its share of dangers, it also, it brought about incredible innovation and opportunity. And I think that's the potential that people see in DeFi and yield farming.
A financial frontier full of risk and possibility. It's intoxicating in a way.
It is. And like any frontier, it's constantly evolving. What Investopedia describes today, I mean, it could be old news tomorrow. That's why continuous learning and research are absolutely crucial in this space.
So where does that leave our intrepid listener who's now got their head spinning with all this talk of liquidity pools and staking rewards and, oh yeah, the looming presence of rug pulls?
Well, I always say, knowledge is the best defense against risk. Investopedia is a great starting point for sure. But don't stop there. Dive deeper into the specific platforms or strategies that, that really pique your interest. Look for reputable sources, join some online communities, and never be afraid to ask questions.
Yeah, the crypto world really thrives on that information sharing, doesn't it?
Absolutely. Engage in conversations, share what you're learning, and just, never stop learning. And who knows, you might just discover your own path to crypto success.
And on that note, we'll wrap up our deep dive into the wild world of yield farming. We've covered a lot of ground today, from the ins and outs of DeFi to the exhilarating highs and, shall we say, gut-wrenching lows of this fast-paced world.
We explored the different roles you can play, from being a liquidity superhero to a staking vigilante. Remember, it's about finding what works best for you, for your risk tolerance and your financial goals.
And if you're eager to keep exploring, don't worry, we got you covered. You'll find links to Investopedia and all those other resources we mentioned right there in the show notes. And be sure to join us next time as we delve into another fascinating corner of the tech world. Until then, happy exploring, and remember, in the world of crypto, fortune favors the well-informed.